good afternoon, everybody. This is Mark Salter, the Executive Director for CFA Society Minnesota. Welcome to Putting Investors First, our annual tradition, where we join with the rest of the worldwide CFA community as part of a month-long global initiative. This actually started nearly 10 years ago. It actually started in our CFA Society Milwaukee group, and it has grown ever since as a way to build awareness of the fiduciary duty to protect investor interests and to encourage financial professionals to place the interests of investors above their own. All right, so putting investors first, but to do what? Toward what end? I think Paul Smith, the former CEO for CFA Institute, hit it right on the mark a couple of years ago when he said, behind every investment transaction, there is an individual whose hopes and dreams depend on this capital, whether it's putting the kids through college, paying the mortgage, or saving for retirement. Investment is about people, and that focus is more important now than ever before. And that brings us to today's event. We are delighted to have John Taft back with us again for the third year in a row, and his colleague and friend, Frank Altman. We are going to turn it over to them in just a second. I very quickly want to say a couple of quick thank yous. Besides John and Frank, I want to thank our annual sponsors, the firms that you see on the screen here, that generously give of their time, talent, and treasure every year to make sure that we can do events like this and all of the other 70+ events we do throughout the year. So thank you, sponsors. We could not do this work without your help. We also wanted to give a quick thank you to CFA Institute. Back when the pandemic started more than a year ago, they reached out to societies across the world and said, would it help you continue what you're doing if we provided a Zoom meetings license? And we quickly said yes. So we always like to thank them for investing in what we do in this very special way. I am going to stop sharing my screen right now and turn it over to Frank and John with just these words to start. I can't think of two people more qualified to talk about today's topic than John Taft, who, as we know, is vice chair of Robert W. Baird and Company, and then Frank Altman, the CEO and founder of Community Reinvestment Fund USA. John is well known to this audience today as a mover and shaker in the financial services industry for more than 35 years, and we are delighted to have him with us again this year. Frank Altman is another mover and shaker in this industry. He pioneered the development of a secondary market for community and economic development loans, and through CRF, the firm he founded, and a network of more than 200 local community partners, he's led the charge to fund more than $3 billion in loans to job-creating small businesses, nonprofits, charter schools, and affordable housing projects all across the US. So John and Frank will talk first for about 45 minutes and then answer questions from the audience. And we'll be using the chat function in Zoom for Q&A today. You're welcome to type your question at any time in the chat window. With that, we are now ready to go. John and Frank, thank you again. Welcome, and please take it away.
Thank you, Mark. Good afternoon. I just have to say it's an honor every year to be asked by the Minnesota CFA Society to host this event around Putting Investors First month. And I could not think of a topic more timely and relevant than the one we are going to talk about today. And it's got lots of different pieces to it, but it's really about getting capital, what is being done, what could be done, what needs to be done to get capital into the hands of, in particular, minority, small business entrepreneurs in disadvantaged communities. I mean, we're all hearing about the widening inequality in America. We're hearing about K-shaped recovery. We're hearing about the disproportionate effects of COVID and social unrest on minority entrepreneurs. And those are among the things we're going to cover today in our conversation with Frank Altman. Frank, I have admired Frank for decades. And I talk about responsible finance. I talk about finance as a force for good, but Frank has been living it, and he has been executing on it throughout his career. And there, we constantly read about innovators in finance. Frank is a true innovator in an area of finance most of us don't spend a lot of time thinking about or acting in the course of our professional lives. So Frank, welcome. Thank you for spending the next hour or so with us. Let me start out, and I know you want to get through this because you got a lot of other things that you want to talk about. By the way, just what Frank and I thought we'd do is take the first part, 10 minutes or so, to talk about Frank's background, how he came to found the CDFI that he runs today, and other things that he's done in this space. Then we thought we'd take the middle of the presentation and talk about what's going on with CDFIs, the new administration's policy towards these kinds of organizations. And then where Frank really wants to spend his time is on the future opportunities that he feels exist in this space. And he's going to be writing a book on this subject, which we hope might be available a year from now, maybe at the CFA Institute's annual meeting as something that CFA Institute would consider sponsoring. So with that, thank you, Frank. Tell us about yourself and tell us about how CRF USA came into being.
Well, thank you, John, and thanks to CFA for the invitation. This is an honor for me. I don't get a chance to spend this amount of time talking about what we do, so I hope I don't put you all to sleep. But there's a lot of excitement, I think, right now in the investing world around how can we do things differently. And I think we've over a period of time we found at CRF a number of ways to channel capital, institutional capital, and hopefully individual investors into the communities that are left behind by traditional financial institutions. And we have a lot of work to do in this country to close the wealth gap, particularly the racial wealth gap, and to rebuild the communities that we have ignored over the last generations, and let flounder. And there's, we're sitting right now in the Twin Cities, where just a day or two ago, we were on edge about whether the city was going to burn down again because of injustice. And injustice, it takes many forms, but one of the forms it takes is financial injustice. And we've seen that over countless generations really in this country, and it's time to make a change. And that means we need to make a change in the system that CFA members are involved in, and what it means to be a fiduciary, whose interests need to be served by investments. And so I'll talk about that a little bit, but I do want to be a little provocative as we talk in getting all of us to think differently, maybe examine assumptions that we don't examine very often about what it is that we do and how we're doing it. So a little of my background. I actually, I'm a native of the Twin Cities. I grew up in Golden Valley, went to Robbinsdale High School, for those of you who are old enough to remember that there was a high school in Robbinsdale. And about sometime over the weekend, I got a Facebook post from the Robbins group site or something of a story about the Walk for Development in 1971, which was the second walk that was done to raise money for community and economic development charities in the Twin Cities and globally. And I was very involved in that in high school. And so there's this article about we were going to have a gathering of all of the social studies classes. And I was quoted in the article about teaching people what it means when you talk about development. That was 50 years ago. I can't believe I'm still doing that stuff. But it's been a long time that we've been working collectively on these issues. And I thought we were making progress, but maybe we're not. So I went into public service out of college and started my career in the state government at the Minnesota Housing Finance Agency. I learned public finance there. I ended up spending some time at the Minnesota Energy Agency, working on the pressing energy problems that the state had in the late 70s. Then I had a chance to seek public office. I ran for state treasurer when I was 29 years old. Didn't win, but it was winning for me because I got into every county of Minnesota. I listened to the problems that people were having. If you remember in 1982, in that era, interest rates were in the double digits and farmers were losing their farms. And as a result of that, I was invited to be a special advisor to Governor Rudy Perpich when he came back into the governorship in 1982. And I served in his administration really until I started CRF in 1988, working directly in his office on policy matters, including economic development, energy, agriculture, environment, a variety of policy issues. And it was in that capacity in the energy years that I met John. John was an advisor to the Energy Agency on our district heating loan program, which I ran. And we've been sort of in parallel paths ever since. So it's fun to be here and reminisce a little bit about then. So if you recall back in the 80s, we were still trying to come out of a recession, and there was high interest rates, and there was a lot of pain, particularly in greater Minnesota. And Governor Perpich and Mark Dayton, who's commissioner of the Department of Energy and Economic Development at the time, really wanted to help preserve farms, preserve off-farm employment opportunities so that people could go to work and keep their farms if they couldn't make a living in the farm itself, and really to save and promote rural economic development. And so we had this program that we wanted to pursue called Minnesota Recovery Fund. And the legislature didn't seem to want to fund that. And so I got the idea that I had a portfolio of loans of about $10 million, that we ought to find a buyer for these loans, put the loans back into cash, and then use that cash to fund this recovery fund. And that idea just wouldn't leave me. In due course, the legislature actually passed the request that the governor and Mark Dayton had requested. So we never sold the loans, but it led to a really interesting discussion in terms of policy development, where I began to talk with a number of people in both greater Minnesota and in the Twin Cities, particularly in the lower income communities, community development corporations and others. And we came up with the idea of creating a market for these loans. In Minnesota at that time, we identified more than 300 community-based loan programs, many of them funded by foundations. Some of them were government funded. Some of them were federally funded through development, economic development districts and so forth. And all these funds had something in common. They were illiquid. And if a borrower came and needed money on Main Street in Crookston, Minnesota, and the Crookston EDA was out of cash, they couldn't help. So these funds were opening windows, closing windows, seeking more money from the government, seeking more money from foundations. And it was a very inefficient system and a very fractionated system. And so the vision was, could we create a market that would buy these loans, buy them out of existing portfolios, and put those loans back to use in the communities that need cash? And that was really the instigation of the thought behind CRF. I started talking to a number of the foundations in the area, and one day, and I also talked with with practitioners. And I really want to give a credit to my co-founder, Warren Hansen, who at the time was running the West Bank Community Development Corporation, and was very interested in organizing the community development corporations in the state around common policies and programs. And so the two of us put our heads together for about a year, working very closely in the back office at it was then Norwest Bank, where we got some initial support for thinking the idea through, working with the Community Affairs Department at the Fed, it's Minneapolis Fed, and coming up with an idea that we thought we ought to test. So one day I got a call from Terry Sario at the Northwest Area Foundation. He said, I want to take you to lunch. And we went to lunch and she ordered wine. And I said, I don't drink wine during work. And she said, well, you're going to today. And she made the offer of changed my life. She said, we love this idea. We want to fund it, but we don't fund the state. So how would you like to quit your job and start a nonprofit? And here we are 33 years later, and it was the best decision I ever made. Although looking back at it, I had no idea what I was doing. So I'll stop there. That's kind of the backstory of how CRF got started. We did get some legislation passed in Minnesota that to make it clear that cities and economic development organizations could sell these loans. And we basically started off virtually with no public money to create the organization, to try to really see if we could create a market-driven capital markets vehicle that would drive capital into these communities that were starving for capital.
So Frank, that was the origin. I remember you back in the day, and I remember being skeptical.
Yes, everybody was.
About the marketability of the loans that you're talking about, because these were loans made by government agencies to projects that were good for the community, but maybe not the most bankable of circumstances. So how has CRF evolved, just briefly, from those origins in terms of packaging and really reselling or securitizing loans to where you are today? Maybe you could just draw us a roadmap.
I want to say that there was a method to our madness on this, and that was trying to understand the risk and then manage for the risk, as opposed to saying we're going to avoid the risk. And the way that we did that was to rely on philanthropy, which at the time, and again in the late 80s, everybody was saying, well, the McKnight Foundation should fund all this stuff. The state doesn't have the money. We got a debt deficit, et cetera. We should look to philanthropy. And philanthropy is saying, no, we don't do that. And what we brought to philanthropy was the idea of using a small amount of their precious capital to take the risk out of these transactions and de-risk them, so that other investors who wouldn't go into these transactions directly would be able to buy slices of the transaction that had the risk profile that they were looking for. And so we created tranche securities, and eventually the securities at the top of the waterfall were rated by S&P. At the last issue we did, 70% of the securities were rated AAA, and all that activity of just doing one issue after another, learning, getting to the point where we were able to attract sort of money center banks, not just our local banks, but we brought in the Ford Foundation as a funder, but we brought in Bank of America and JP Morgan and a whole number of others that came in and began investing in buying our securities. Now, they got credit under the Community Reinvestment Act, so there was an incentive for them to find these things, but it became a really virtuous cycle, if you will, in terms of how we were putting these things together and getting in the marketplace, and relying on a network of people on the ground who understood their communities, who were wanting to see these businesses and other projects succeed. So they didn't. You couldn't take this to the bank and say, here's a credit support, but there was a informal support system for many of these businesses, and we didn't see a lot of defaults and delinquencies until 2000 2009 when everybody saw that. So so 2009 obviously that changed the course for a lot of us in terms of how we went into the marketplace. But prior to that, we were really building something that we thought was going to be hugely successful. And we issued about $800 million in asset-backed securities, and only a very thin amount were actually not fully repaid. And those were basically investments that socially motivated investors made, not financially motivated investors. So.
You mentioned CRA credit for banks that participated with you. That's because, if I understand it, you set up CRF USA as a community development finance institution. Is that correct?
Actually, no. There was no such thing as a community development financial institution in 1988. There were things that were called community development corporations that had really come out of the Johnson era, the Great Society. A lot of those were focused on bringing capital to low-income communities, but by doing things like weatherization, some job creation. There weren't a lot of community development corporations that were lending. So we were setting up a CDFI, but we didn't know what that was yet. That didn't actually come into play as a formal designation until 1996. So almost 10 years later.
All right. Well, you're a CDFI now. How many other CDFIs are there? How many of them look like CRF? And what other forms do they take?
First of all, let me just explain what a CDFI is. A community development financial institution. In government, we have to come up with the most complicated things to describe what we're doing. These were set up. These came from a promise that Bill Clinton made on the campaign trail when he was running for president. He had gone to Chicago and seen the tremendous work that South Shore Bank had done in the low-income areas on the south side of Chicago. And he made a pledge. He said, we're going to create 100 community development banks like this one. Well, there were a lot of organizations that were already in the field doing lending. Many of them were nonprofits. Many of them were very grassroots and community-based. And they said, well, wait a minute, we're here right now. That's what we're doing. So there was a negotiation that went on within the Congress and the administration. And they came up with the idea of, instead of saying banks, that they would fund community development financial institutions, and that the funding and authority for these institutions would not be at HUD or the other sort of agencies you would think about. It would be at the Treasury Department. And so the Treasury Department actually operates what is called the Cdfi Fund. And that fund certifies organizations, and then it, on a competitive basis, capitalizes them with matching grants. So all the organizations that receive funding from the Cdfi Fund have to raise at least the same amount of capital from the private sector, and they helps capitalize balance sheets. So Cdfi Fund started operating in the late 90s, and there were probably a handful of CDFIs, and now there are more than 1,100 around the country. All CDFIs must have a primary mission of serving low-income targeted populations or low-income communities, as noted by unemployment and median incomes at the census tract level. So very, very focused on getting capital into communities that are underserved.
So I wrote an article, I think it was a year ago, and it was about capital lifelines for small businesses fraying. In other words, the funding challenges you were facing. And of course, COVID only made that worse. But there has been a sea change in Washington in both the attitude towards and the dollars that the government has made available to CDFIs. Do you want to talk about that and what the landscape right now looks like as far as supporting organizations like yours?
I think it's important to understand the breadth and diversity of CDFIs. So there are many CDFIs that are really community-based. They serve a small geographic area. They might serve a particular community, like in the Twin Cities, the African Development Center works very, very closely and deeply with East African immigrants and in building businesses. There's other groups, Latino Economic Development Center, that work with Latino entrepreneurs. And around the country, that's very common, that you have these organizations that are making $3 to $5 million in loans a year. And again, they have liquidity issues, so there's a role there. Most of these organizations are 501c3 nonprofits, so they can raise money from the philanthropic world and from individual donations. But that leaves, that's a challenge, and I'll come back to that in a second. But then there also are community development financial institutions that are regulated depositories. In the Twin Cities, the most prominent one would be, now I'm blanking on the name, and I was on their board. This is terrible. I want to say Franklin Bank, but I'm living in the past. Anyway, Sunrise Banks, thank God. Sunrise Banks is doing a huge amount of work as a CDFI bank, and they have access to deposits and liquidity that nonprofits don't have. And there are a number of CDFI banks and credit unions around the country. So you put these kind of into these different categories. And then there are also CDFIs that specialize in certain industries or types of impact that they're trying to make. Many CDFIs focus on affordable housing, and they do a lot of work in that area, or on nonprofit facilities and helping boys and girls clubs build facilities or such things. And only recently have CDFIs really begun being major forces in business lending. Unlike CRF, we've been doing this since the very beginning. A lot of CDFIs have moved into business lending by first having been involved with micro lending. So making very small loans to entrepreneurs, almost like personal loans, and now moving up into larger loan. So that gives you sort of a landscape of who's out there. And during the entire history of CDFIs, there has been bipartisan support in the Congress for what they do. And there's generally been appropriations, oftentimes that are higher than what the president's budget asked for. Even under President Trump, the amount of money coming into CDFIs was significant, about $250 million a year, available to mostly capitalize CDFIs through financial assistance awards. And so now we have a robust network of CDFIs that are capitalized well, and they're in the right place at this challenging time to deliver capital at scale to small businesses and communities that are not well served by banks and others. And that's what the administration is looking at. Interestingly, in the CARES Act, the last act signed by President Trump, there was billions of dollars were included in that act to support the lending and capital needs of CDFIs, about $12 billion altogether. And that money is working its way through now through the Treasury Department and will be coming on the CDFI balance sheets before the end of September, and really will be critical in the efforts to recover and help businesses recover as they try to reopen and deal with a lot of the debt and default issues that they're dealing with. So I think it's going to be a great time to the extent that people can find the CDFIs they're looking for, and vice versa.
You were very active, as you told me, in working with a network of similar organizations to originate PPP loans in the wake of COVID. Do you want to talk about what that
Sure.
looked like?
So I mentioned that after the crash, we all had to change our business models, and we spent 2 years making sure that our ship didn't sink, and we were in good shape. But we didn't make a lot of loans. We were pretty much frozen out of the securitization market was non-existent. And what we found was, the only thing that was trading reliably during that period of time in the capital markets were government guaranteed instruments. And so we had strategically looked at becoming a Small Business Administration SBA 7A lender, which is a federal program that guarantees loans to small businesses. There are 14 non-bank, national non-bank small business lending company licenses in the country, and they're limited. They're like a, well, I don't want to say they're like a Chicago taxi medallion anymore because they're not worth much, but at the time, they were trading for tens of millions of dollars, and we just didn't have the resources to get one. When the crash came, a sponsor of one of these companies filed bankruptcy, and we were able to buy a very troubled portfolio, but get the license for several $100,000 and get into the business of making guaranteed loans and accessing capital markets through the very liquid SBA secondary market. So we were in place, we had that in place around 2011, and we became the largest nonprofit SBA lender in the country. And you might say, well, what is the CDFI doing making SBA loans? There's 24 billion of these made every year, but they're not being made by, at any stretch of the imagination, they're not being made at scale to Black-owned businesses, to Latino-owned businesses, to women, veterans. And so we said, we're going to take this tool and we're going to intentionally point it toward the industries and populations that are not being well served by the banks that make these loans. And we're going to really try to build that market. So about 70% of our loans coming into the COVID period were being made to women, veterans, and people of color, compared with less than 20% across the SBA in general. And if you look at African-American owned businesses, they're in the single digits in terms of percentages. So that was our mission. And then when COVID hit and PPP came, we were in place to be able to start originating these loans. And we were in place for two reasons. We had the license. Most CDFIs did not at the beginning of the program, did not have the authority to make these loans. And we had a technology platform that we had developed to originate these loans called Spark. And we retrofitted Spark quickly to be able to launch the PPP program on the day that it opened in April 3rd of last year. And since then, we've made $750 million worth of PPP loans using a network of 70 other community development organizations that didn't have the ability to make these loans themselves, particularly at the beginning. And instead, they worked with bringing their borrowers, helping their borrowers go through the application process, all remotely, all using the technology that we're all using today. And we're able to then get an expedited approval from CRF and through the SBA. And so we've those businesses that receive these loans have saved more than 70,000 jobs. The median loan size, and I think this is really important because it tells you what a CDFI can do that banks don't do because of the different nature of the financial models. The median loan size to small businesses that we've made under PPP is $21,000. That means half the loans that we're making were to sole proprietors, to people who had one or two employees, to the landscaper who and the guy who plows snow in the winter and had to keep the payments up on the plow, all that sort of thing. And we also made a lot of PPP loans to nonprofits that were never heretofore able to access SBA lending. So, but we would not have been able to do that if we hadn't had this network of other CDFIs who have a trusting relationship and were willing to bring their borrowers to us. And we're continuing to do that. I don't know exactly where we're going to end up, but it's going to be somewhere in that $700 to $800 million range before we're done. And CDFIs over time were allowed to make PPP loans, and we got many CDFIs to use the technology platform that we have, this Spark, and another one to connect their borrowers called Connect to Capital. In between those two technology platforms, there have been, well, just on Spark alone, about $9 billion worth of PPP loans have been originated across a variety of originators.
Thank you. Just one more question before we get into the whole issue of what needs to change and what the possibilities might look like. But just to summarize, what are the challenges, the core challenges that the constituency you're serving faces?
Well, in general, I mean, first of all, the industry has a challenge because nobody knows who's got the money. I mean, we are very mission oriented, but as an industry, we are not very brand aware, and so it's hard to find a CDFI. When an organization finds one, and the Federal Reserve does various studies, and they've looked at satisfaction and lending and so forth. The first place people go is to a bank. The second place they're going is to fintechs. And fintechs, there's a range of fintechs that some of them are very responsible and others are bloodsuckers, basically. And they can kill a business as much as they can save one. And when they find a CDFI, it's the least, it's like 5%, but that actually find a CDFI, but 98% are satisfied, highly satisfied with what they got. They get the loan they ask for, they get the amount they ask for. Banks, just the opposite. Very low satisfaction rate, and oftentimes the amount of money that is being requested is not actually lent. Higher turn down rates, et cetera, et cetera. So that's a first challenge, is making people aware of CDFIs. And I'm hopeful that with all that's going on right now with PPP and the fact that so many businesses have been exposed to CDFIs through the PPP process means they're going to come back when they need more traditional funding. And so we'll see how that goes. Then CDFIs and I would say low-income communities, recent immigrant communities, many of the communities that CDFIs serve oftentimes are in service businesses. So they're not heavily into manufacturing. They're into restaurants and nail salons and barbershops. And as you know, a lot of those businesses have been shuttered. So there's a huge challenge right now about the viability of these businesses coming back. Yet, unlike some of the big name restaurant chains you can think about where there's a lot of risk. And by the way, banks don't like making loans to restaurants. They just don't. There's a fear there. This is the livelihood of these people, and they're going to do whatever they can to keep their businesses afloat. And so CDFIs have the ability now, with this influx of capital, I think, to really help nurture those businesses back to health. So that's another challenge, just what the industry is that they're in. And then there's another challenge, and this I think starts to get to the sort of how do we think differently about finance? And that is, there's generally a collateral gap that many of the borrowers at CDFIs finance. A collateral gap that would make these businesses unbankable or not easily able to access capital at reasonable rates. And that collateral gap widens dramatically when you look at people of color. So as we think about, what makes a white male underwriter comfortable, lots of collateral, right? I got to have but what that does, do we really need it, or is it belt and suspenders and safety net? And at the same time, we're systematically saying the community that doesn't have the resources and assets, we're not going to lend to. And so that's a challenge, I think, that maybe moves us into the next phase. So
in the promotional materials that went out to entice the 53 people who are listening to us today, we said that you want to shake up the financial system so dollars flow more directly to small businesses in Black and brown neighborhoods.
Correct.
Like Elizabeth Warren, you have a plan for that.
Well,
why don't you tell us about?
First of all, we have a track record, right? We've done this. We've gotten billions of dollars into low-income communities using a variety of tools, lending, buying loans from others so they can lend. We also helped create something called the Federal New Markets Tax Credit, which is a big program, but all of the investments under that program have to be in very distressed areas. And so if you think about the Twin Cities, we have funded a number of of loans. We funded using new markets. We funded a bakery on the east side of St. Paul that was supplying hamburger buns to McDonald's, and they created a huge number of jobs in a very low income area, high paying jobs that they were looking at in order to build. They were looking at going to Wisconsin. The city, we work together, public, private, nonprofit, work together on this stuff, but we got that done. In Minneapolis, we funded using new markets. We funded the revival of the Capri Theater on West Broadway, North Minneapolis, on Lake Street, in the heart of where the damage was done after George Floyd. We provided the last capital necessary using a new markets investment to revitalize and reopen the old Sears building, now the Global Marketplace and the Atlantic Commons. We funded the Atlantic Commons portion of that. That was a big deal. A lot of different CDFIs brought their resources together to get that building reopened after having been closed and open to the birds and the bats for more than 10 years. And so that's another thing. CDFIs will go into areas first before the rest of the market is ready to come. And obviously that's been a successful project now for many years. Obviously it's in the middle of an area now where we have some new challenges and maybe new opportunities for CDFIs to step in as we try to rebuild in that corridor. But we've been involved with those. So in most cases, to get this money to flow, there's some government involvement. There's a guarantee. There's a tax credit that entices investors that makes it possible for them to de-risk. And a lot of what we try to do is to create investment vehicles that de-risk and leverage private capital. But we're not doing enough. I'll give you some examples where I've got some tire tracks on my back. Back in the early days, we actually got a board member to join our board from Robert W. Baird, and he was the head of fixed income at the time, and he went to the Milwaukee County Pension Fund and the state of Milwaukee. He said, we're gonna show you how to do economically targeted investing. And so he got pension funds to buy unrated, privately placed CRF securities that had loans in them in the city of Milwaukee and some of the lowest income neighborhoods, and they performed extremely well. And we actually prepaid them, and the concerns that the pension funds had about investing in this went away to why we love this security. We want more. Well, over time, we tried to make sure that, because I'm talking to CFA here and fiduciaries and people who manage insurance company money and others, how do we get the insurance industry to be able to invest more directly in these communities? And so we went to the Labor Department and we got a letter from the Secretary of Labor regarding ERISA, and that letter basically said that a pension fund can invest. It has to follow the fiduciary requirements, obviously, the prudent person rule and so forth, but they can take ancillary benefits into account in their investing. So that was kind of the opening of the door. Oh my God, that door slammed on us so fast with people saying that's absolutely not the way we do things, and we're not going to do that. And then the next administration came in and they took that letter away and said, and the treasurer of the city of New York came online and said that this is not the kind of investing that any pension fund should be doing. And so now we think about, so now I'm going to try to get into this, shake it up a little bit. Well, who's the beneficiary of a public pension fund or a private pension fund? Is it only the person or the business that's contributing to the fund? Or is it also the beneficiary that is receiving payments from the fund? And if you think about the time horizon of a pension fund investment, I mean, pension funds are investing for infinity to a large extent, managing to actuarial data and so forth. if your pension fund says, we will not put money into South Minneapolis, that is a dangerous place. We're not going to do that no matter what. They're not going to say it in those terms, but they're saying that. And the plan participants who are living in South Minneapolis and seeing the values of their houses go down and are now retiring and can't have lost the wealth that they might otherwise have had if there was a thriving community. So who's benefiting from that? Who is the beneficiary? And that's what I think we need to be rethinking about, just thinking about that particular part of the industry. And hopefully I'm going to get a lot of questions and pushback on this. And then there are all the limitations that we have around who can invest and how you can invest. And so we went the route of private placements and ultimately getting S&P ratings, which helped a lot. But the investors were still institutions. And it's only been recently that CDFIs have come up with ways for individuals to actually invest directly in the CDFI. And the most prominent of these is Calvert Community Impact, which was a nonprofit spun out of the Calvert mutual funds maybe 25 years ago. They raised money. They actually went to every state, blue skied what they call the Calvert note, and made that note, gave it a QSIP, put it DTS, and got it on trading platforms. And today, if you want to invest in a CDFI through Calvert, you can call your broker and say, I want to buy $5,000 in Calvert notes maturing in 2 years, and they'll find them for you. So that's the beginning, but that's only the beginning. What we really need is a way moving forward to make it easier to invest and to anticipate the changing demands of investors who are looking for social impact in their investing. And we're seeing this particularly among millennials who are moving now into managing their family assets, coming, particularly high net worth. They don't want to just invest for return. They want to invest for improving the lives of stakeholders in the communities that they're in. And that's the challenge before us, I think. And that's one of the things I hope we can get into in the discussion. So,
well, the growth of the impact investing sleeve of socially responsible investing, Frank, can only be helpful. That's really one of the areas that you're talking about.
Exactly. And most of the impact investors.
I'm on the board of the Minneapolis Foundation. If I'm not correct, you'll correct me, I'm sure. But there is an impact fund that donors at the Minneapolis Foundation can direct dollars to.
Right.
And my understanding is that that impact fund is making investments in your CDFI and others.
Yes.
Is that right? So
we were the first investment. I think they invested $2.5 or $3 million into CRF, but it was the input for that came from the Calvert note. Calvert raised the money, got it into the fund. Then the fund was able to.
Right, and there's an example of, you have this community of donors who care about investing in the community, and the foundation serves as an intermediary and finds somebody who knows how to do that, i.e. CRF USA or others.
Correct.
I think that you're going to see more of that as impact investing becomes more common and widespread. Would be my thought.
John,
well, Mark,
can I just
please
give a little? I want to sort of frame impact investing because it's a big word, and people come to this discussion with their own preconceptions. And so I want to just parse it a little bit, and that is, think about impact investing on a spectrum or a continuum, where on the edges of that continuum are the highest risks. So if you're a socially motivated investor or a charitable investor, or somebody who says, I'm investing primarily to get social impact. Yeah, I want my money back, but I don't care about making the last basis point of return. I want to see the return in social improvement. I would call those types of investors socially motivated investors, and its impact first. And the most risky thing that an investor, if you want to use that term, can do is to give the money away. A foundation, make a grant. That's the riskiest thing, because once that money is out, you have no ability to take it back if the impact didn't occur. You're basically hoping that the purpose of the grant is going to be fulfilled. On the other end of the spectrum, you have financially motivated investors. That's return first. Social impact may be a consideration, just like at the ancillary benefits we talked about with a pension fund investing. And the riskiest thing there, obviously, is an equity investment. But you have all these different types of investments that go along from the risk on the outside to inside. You have mezzanine debt. You have secured debt. You have bank deposits that can be cash that can be used as a backstop for things, both in the market rate returns, and also on the other end of the spectrum in the sort of socially motivated returns first. So I always try to get people to understand we're not talking about all this as one big blob. We're talking about the segments and trying to match the requirements of the investor to the instruments that are available for the investor to invest in. And I think our challenge as an industry is to build out that full panoply. Right now we don't. We've got debt products and we've got a lot of investors that require ratings, and so we have still a mismatch there. But I just wanted to get that concept out in front of people.
Thank you. Mark, let me check in with you and see if there are any questions from participants in today's call that we can address.
Not yet. They're all being shy Minnesotans thus far.
All right.
Yeah.
I have one that was sent to me by Tom Camp. Now, Tom's photograph is on the screen, and it's 2 pages long. So I'm going to try to summarize it. And apologies, Tom, in advance if I don't get it right. But essentially, your point was that there are any number of organizations and individuals that want to invest in underserved communities. Here he is. Why don't you ask it? Go ahead.
Hello, John, and hello, Frank. Thank you very much for this opportunity to listen to you today. I thought your presentation was excellent. Thank you, and thank you for all the work that you're doing in communities that desperately need investment. I've been aware of this area for a long time. Very quickly, my point is, I think there's lots of us, myself included, that want to invest and help economic development. But when I see the kind of political response that's gone on recently and the increased violence in the city of Minneapolis, for instance, while I was approached to invest recently in a real estate project in Minneapolis recently, I turned it down and said, I'm scared because of the negative downward spiral that our city seems to be in. And so what are you doing to work with the legislature and the governor and others to bring about a safer environment for everyone? And so, to really boost investment.
I would expand the question to say, what can you tell someone like Tom to make him more comfortable investing in the community?
Thank you.
Well, obviously we are recovering from a terrible set of circumstances coming out of the death of George Floyd, and an eruption of pent-up anger and frustration that led to the violence and the destruction that occurred after that. And I have to say that very early in CRF's history, when we first started going beyond Minnesota, I was invited to California and to meet with people in Los Angeles. And the day before I left for that meeting, Rodney King was televised, and the city of Los Angeles burned. And we actually met in a city building that was boarded up, and the windows were all shattered. And I didn't think the meeting was going to happen, but it did. And we drove through the person I was with through the areas that had been damaged, and it was sobering. And the answer to your question is not an easy one, because the outcome of violence that we've seen, and we see, it seems like every 15 or 20 years there's another one, is a direct result of the lack of investment that we're making in these communities. And it's not just in physical structures and infrastructure or businesses, it's in people. And our Twin Cities, I think there was an op-ed in the New York Times in the last couple of days talking about it's a great place, it's a wonderful place to live unless you're Black. And we need to confront that and understand what led up to the conflagration that occurred, and frankly, what led up to the police response to begin with. And so, that is a problem we've got to deal with, and it's not going to be solved overnight. So how do we convince you to invest? It's got to happen, and the way, whether it's you investing or somebody, other people, we've got to invest in these communities, and we have to find ways of trying to de-risk the investment. And de-risking the financial part of the investment can be done, right? So de-risking the community part of the investment is going to take time, and it's going to have to involve very frank discussions and uncomfortable discussions within our communities, so that we really understand what we need to do differently. After the George Floyd death and the civil unrest that followed it, I was invited to speak to the US CIF forum, the Forum for Socially Responsible Investing. And I had served on that board for a number of years. And I said, the first thing that we all have to do is to interrogate our policies, processes, and procedures to try to identify and root out unintended or unconscious bias. Because we know that the ability for a Black person to get a mortgage it's 2.5 times less likely that a Black person is going to get a mortgage than a white person with the same income. And we say we have fair lending, we have all these rules around it. Yet when you look at the data show that there is some sort of bias that is keeping capital from going into the communities of color, and particularly Black communities. And obviously, when we require a certain level of equity for somebody to start a business, white people can go and start their business by taking a second mortgage on their house and using the home equity they've got to put it into the business and put it at risk. They're taking a risk, they're moving things around, but they can do it. And they likely have somebody in their family who's got some wealth and so forth. When you get into the African American community, the individuals have very low net worth, very unlikely to have a friends and family network that has net worth. And so if they're going to start a business, they're going to start one that requires very low capital requirements. And again, we get into this issue of the restaurants, barbershops, et cetera, et cetera. So I'm kind of rambling here, but to say that we can financially de-risk investments so that you can feel financially comfortable. If we're going to de-risk the possibility of civil unrest, we got to make a lot of changes, and we got to listen to people and listen to their pain. And we need to feel some pain as a result, because the problem is it's not a one-way problem. It's a community problem. We got to fix it, and we have to do it differently. That's all I can say.
That's well done, Frank. You might want to consider running for public office again. It might be time.
I've done that.
Mark, I'm looking at the chat room. Don't see any questions. We're at the top of the hour. So if it's okay with you, I thought I'd finish with one zinger for Frank. You recently woke up and learned that you were going to be the recipient, the CRF USA, of a $15 million grant equity infusion from Mackenzie Scott, Jeff Bezos's ex-wife. I think you told me you had no idea that was happening. My question is, well, I have several. A, did you ever talk to her about that? B, did you know what, do you know what she was trying to accomplish? And C, what does it mean for your organization?
Well, first of all, it was an interesting process. This happened last October. And I had been loosely following the Bezos story and also loosely following the giving pledge the billionaires were making, I think started by Bill Gates and Warren Buffett, to give away at least half your assets during your lifetime. And some people have signed on to that, but I wasn't really focused on that because you don't call up Jeff Bezos and say, I'd like to be, a grantee. That's not how it works. There's a lot of isolation there, and and a lot of people set up foundations, and you go through the foundation process. And raising money from a foundation, there's a dance that goes on there, and it can take years. So what Mackenzie Scott did was really quite unique. She said, I'm gonna give away. I start giving away my money, and she's given away 6.4 billion, I think, since she started this. And I'm going to look for organizations that are high performing, and I'm going to invest in them and let them do their thing. So unlike most foundations that give you a whole list of deliverables you got to do, and you got to do reports, everything, she tried to identify groups that she thought were best in class or had high impact, and they're having more capital would allow them to do more. And she decided to expand from she actually made contributions to a lot of different kinds of organizations. I don't know if everybody followed this, but she, in many cases, doubled the endowments of historically Black colleges and universities. She just put like $40 billion into Morehouse. I forget all the ones she did, but lots of money just to say we're gonna make these institutions much stronger. But she did something that, and this is how I began to find out what was going on. She wanted to look at what CDFIs do, and nobody had really made the kind of investments in CDFIs from a charitable perspective that she was considering. So she worked with a well-known philanthropic consulting company called the Bridgespan Group out of Boston, and they were familiar with CDFIs, and I think what they did was vetted them. So we got a call from Bridgespan in early October, and a person I know there, and he said, we have a client who's thinking about going into this area with investment, and would you be willing? They're looking for examples of CDFIs and what they do. Would you be willing to share your financial data with us and your financial statements? Just a few things. No application. They look at the website, and they said if they're interested, you'll hear back, but you won't hear from us. They'll contact you directly. A week later, I got a call from a woman who said she wanted a confidential discussion with me, and so we arranged it. And she said, "I'm calling to inform you that CRF has been selected to receive a $15 million unrestricted grant from an anonymous donor, and I want you to keep this donor anonymous until we give you permission." And oh my God, I said, well, can I know who the donor is? And she said, yes, of course. So she told me, but she said, don't discuss this with anyone. And if anyone needs to know where this money is coming from, you need to contact us first. So I think what Mackenzie Scott was trying to do was to make all these commitments first and then announce a big thing. But somewhere along the line, it got leaked and it got out in the Council on Foundations publication, I believe. And so then we were able to talk about it. So I didn't have to keep this to myself for 6 months, but it was pretty amazing. And what I tell people, maybe I'm the only one who's old enough to remember this, but when I was a kid, I used to watch a TV show called The Millionaire. And every episode, there'd be some downtrodden family or some cause that needed money. And this millionaire's representative would come and write a check for $1 million to this family. And you never knew who the donor was. And that's exactly what I felt like. And I fell on the floor. And obviously we had a number of gifts made to other nonprofits in Minnesota. And I'm very happy to say that Warren Hansen, our CRF co-founder, who went on to co-found the Greater Minnesota Housing Fund, his group also received $7 million from her. So what is that doing? I think it's changing the nature of philanthropy, and it's showing the way for the mega billionaires and the one percenters in this country to think differently about how they give. And I'm hoping that she's setting a trend that others will follow, whether it's to CDFIs or others, and not necessarily set up all the apparatus that makes it very complicated to access charitable dollars. So, and we currently are, because of that gift, we are rethinking all of our strategies, and also through the lens of racial and economic justice. And we hope to have a strategic plan done by the end of June. So.
Thank you.
Thank you, Frank. This is Mark. I'm breaking in because we're starting to lose a few people. I'm hoping that they'll be able to catch this piece, these last few minutes on the replay when we publish that. But I do have two other questions that have come through. One came to me directly, and the other one came out into the general chat. So two questions for you, Frank and John. Right now, if an individual investor wants to make a difference and make an investment, what is the most direct way to do that?
Well, I'd start by saying the most direct way is to invest in a note issued by a CDFI, and Calvert started the trend, and they're certainly available. Calvert notes are available. But a number of CDFIs now are issuing their own notes or are issuing corporate bonds. As I indicated, we kind of showed the world that it was possible to get a CDFI asset-backed security rated by S&P. We now have a number of large CDFIs that are actually corporately rated by S&P, and a number of them are investment grade, and they're issuing bonds. In fact, the largest CDFI in the country is the Local Initiative Support Corporation out of New York. They just issued a $100 million general obligation bond rated by S&P, and individual investors could invest in that. Now that bond has been placed, but there are going to be more of those coming along, and we maybe can be helpful in letting people know when they're available. That's an easy way, and it's a debt instrument, obviously. We are looking at setting up partnerships that individuals can invest in as limited partners, and some CDFIs do that. I should say that we are on the cusp at CRF of creating a rural business investment company that will be in place. I'm not going to say anything more about it because I don't want to run afoul of SEC laws, but when it's available, we would be happy to let you know. There'll be opportunities for investors there as well. And other CDFIs do similar things, set up partnerships and manage funds. The last thing I would say is, as we come out of COVID, many states are creating recovery funds that involve CDFIs, and there will be opportunities, I think, to invest in those recovery funds. There is another program that is just coming out of the federal government called the State Small Business Credit Initiative, and that is going to be inducing $10 billion worth of investment into small businesses through state plans. And we're working very hard to get CDFIs into those plans, and there'll be opportunities, I think, for investors coming down the pike there as well.
Frank, we would love to hear back from you at some point and get that word out to this community, because I'll really a really quick story. Back in May, when we were all watching the news coverage and seeing what was happening all along Lake Street and in our community, I had several CFA charter holders reach out to me and say, there has to be something we can do. What can we do? We need to get money into those areas. So I believe that there's a very strong interest in finding solutions to this problem and people ready to jump in. But we also want to test that. So very quickly, I'm going to open up a poll with 4 questions that we wanted to ask all of you folks on the webinar today to kind of assess the general readiness for investing in this way, for social impact investing. So I'm going to have all 4 of these questions open for you right now, and we'll share the results in just a couple minutes. So the first question: are you actively seeking impact investments at this time? The second question, if you answered yes to number 1, what type of investment are you seeking? Debt, equity, real assets, or any asset class? Number 3, what is your target investment size per investment? With some buckets there of $100,000, $250,000, $500,000, or $1 million or greater. And finally, what level of return are you seeking? 0 to 2%, 3 to 5%, 6 to 9%, 10% or more. So we'll leave these 4 questions up for just another 60 seconds or so, and share the results in just a minute. And we'll make sure that that the people who need to know about this, as they're designing these new opportunities that you've been describing, Frank, that people know what it is this particular investment community is interested in doing. So.
While we're waiting, I'd like to just comment a little bit more on the Lake Street corridor.
Sure.
Because and this gets back to the earlier question about, how do we de-risk the potential? Over the years leading up to I would say early to mid 2000s, CRF, working together with the city of Minneapolis and other community development organizations and banks, made or funded more than 100 loans in the Lake Street Franklin Avenue corridor, and most of those loans have paid off. We helped to repopulate closed storefronts. We made a loan to the owner of the building where Officer Taft was murdered, and that building was kind of vacant for years, and really helped to bring that street back to life. There was a lot of risk there, but we were able to do it, and those loans performed during most of those loans performed during the crash of 2008 and beyond. And so now we have to do that again. We have to do it better and different. And when I say we, I'm talking about the community, and help build that corridor back, and particularly build back the opportunity for wealth and intergenerational wealth creation in the lower income communities that we're trying to serve. And so I think we've got a great opportunity in front of us again, for unfortunate reasons, but really to help rebuild and not leave a corridor desolate, or the corridors that were damaged desolate for years to come.
I would agree. We have a wonderful opportunity, and I think we have people who are more than willing to be part of that effort. So I'm sharing the poll results screen with you right now. The vast majority of the folks attending today are actively seeking investments at this time, and varying degrees of investment and different asset classes. So I think, oops, there we go. I believe I believe you can now see the results there. So, Frank, does that surprise you to see that there's that level of interest among the?
I'm very heartened, and I'm also surprised that people are willing to look at 3 to 5% returns. So there's some real opportunity there. I mean, there's obviously there's a range of returns that people are looking for, and institutions. So I think there's a real opportunity for future engagement around this whole topic.
Agreed. Okay. All right, John, I'm going to toss it back to you for any closing comments. One last question for Frank, or and then I'll come back and say one last thank you.
Oh, I thought it was fabulous, Frank. You did a wonderful job. You made me look good, which of course was my number one concern. And I think you probably introduced some exciting ideas to a community of financial professionals can actually be enlisted in the cause that you've been working on for all these decades. So thank you again for agreeing to do this. It was very stimulating and informative, and I appreciate it. And back over to you, Mark.
And I will just close by saying once again, thank you to John for helping us with these important conversations over the last couple of years. And Frank, thank you for joining the conversation. And we look forward to more from you and look forward to continuing this conversation in future iterations, future events. So much appreciated.
I appreciate the opportunity as well, Mark, and I'm going to put a little plug in if you want to continue to follow CRF. Our website is www.crfusa.com, and we're also you can follow us on social media on Facebook and Twitter and LinkedIn. So I'm happy to follow up with anyone individually later if there are further questions that you might have. We are a national organization. There are other CFA chapters. Maybe there's going to be an opportunity for others to learn about what we do as well. So thank you very much.
Thank you again, and we will do our best to spread the good word. And when we send out the replay information, we'll make sure that people, that we repeat that website address and extend that invitation. So with that, ladies and gentlemen, we're going to end a couple of minutes early and give you back 10 minutes in your busy days. And we look forward to seeing you all again in the future. Take care, everyone.